Hello, I'm Sally Baudet. Welcome to Global Business Europe. Our top stories. China bets on artificial intelligence and advanced manufacturing as the world's second biggest economy sets out its growth path. The US economy loses momentum as it weathers the financial impact of tariffs and the conflict in Iran. Eurozone growth hits its strongest pace in more than a year, but which economies are leading the recovery? And electric cars stay in the fast lane despite a slowing global auto market. Now, China has set out its economic priorities for the second half of the year at a meeting of the Communist Party's Politburo. It's a major decision-making body led by President Xi Jinping. It's closely watched by global investors and businesses because China's policy direction can influence everything from trade and manufacturing to commodity prices and financial markets round the world. They highlighted the importance of keeping the world's second biggest economy growing. Here is how they plan on doing just that. First, by boosting spending and investment, Beijing wants to support consumers and businesses through more government backing, easier financing and measures to drive demand. China is also doubling down on the industries it believes will drive future growth. Things like artificial intelligence, advanced manufacturing, scientific research and major infrastructure projects. Another priority is improving confidence in the economy. China's leadership says it will work to stabilize the property market, support private businesses, and continue attracting foreign investment to support long-term growth. China also wants to deepen global trade ties. Of course, this comes at a time of rising trade tensions with both the United States and the European Union over tariffs, electric vehicles, and other strategic industries. And finally, leaders pledged to curb what they call involution-style competition. Now, this is essentially where companies repeatedly slash prices, undercutting each other to win market share. The aim is to prevent a race to the bottom that squeezes profits and weakens long-term growth. Let's get more now on the industries that China hopes will power future economic growth. Here's our correspondent, Dai Kai.
China's top leadership has mapped out the country's economic priorities for the second half of the year. This comes after a resilient first half despite global headwinds. So what signals are policymakers sending, and where should the country focus next? Let's get some expert insight. Many economists see the growth of high-tech manufacturing as one of the strongest signs of China's economic resilience. Emerging industries, particularly artificial intelligence, robotics, and innovative pharmaceuticals, have expanded rapidly. Looking at China's first half economic data, what are some of the indicators that best show the economy's resilience? Are we seeing new quality productive forces gain real traction in key industries?
The development of new quality productive forces has become a major driver of China's economic growth. It has helped offset the slowdown caused by the real estate sector while creating new engines of growth for the economy.
Boosting domestic demand is a major focus of the meeting. Policies such as the Consumer Goods Trade-in Program have helped support spending. For the second half of the year, the emphasis is expected to shift beyond goods consumption towards services and more personalized, higher quality consumption.
This year, China has issued 1.3 trillion yuan in ultra-long-term special treasury bonds, while the issuance of local government special purpose bonds has also progressed steadily. In the second half, stronger government spending, especially on new types of investment, can further support economic growth.
The meeting also underscored that international trade and foreign investment remain key parts of China's growth strategy. So where are the next opportunities likely to emerge?
China's exports continue to face significant external pressure, so expanding institutional opening up will be important. That means not only supporting goods exports, but also boosting services exports. Further opening the financial sector and capital markets could also make it easier for international investors to increase their presence in China.
Looking ahead, experts say stronger fiscal support will be key as government spending translates into income for households and businesses. On the monetary side, a combination of policy tools, including reserve requirement ratio and interest rate cuts, could provide more liquidity to support the economy. At the heart of these policies is to strengthen domestic demand further. Experts say that should keep China on track to meet its annual growth target. 戴凯 CGTN 北京。
Mark Oswald is Chief Economist and Global Strategist at ADM Investor Services International. Hello, Mark. So the context of this, of course, is that there's been less than perfect growth for China in the last quarter. So they're really pushing to up that forecast. Why the focus on domestic spending? What is it about the Chinese consumer that makes them a little reluctant to splash the cash?
Well, I think that's actually not too difficult to identify. What you've seen in terms of the makeup of the labour market is a fairly rapid increase in the so-called gig economy, i.e. workers without a lot of social safety nets, and a drop in the formal labour market, and fairly stagnant income growth over the past couple of years, in no small part partly due to involution. There's no doubt that that's contributing, and to trade wars. So that's the big challenge now.
One of the big pushes is AI+, which essentially China wants to see artificial intelligence throughout the economy, basically revolutionizing everything. How is this going to help sort of boost consumer spending, for example?
That I'm not so sure about. It certainly is going to make things more efficient, likely improve profits, and it's definitely going to improve the supply of both goods and of services. But as we've already identified, the real problem is how much of a boost is it going to give to incomes? And on that, I think the jury will have to remain out. What I wouldn't dispute, though, is there's not really any need for additional stimulus, given that government spending in China is actually lower than has been budgeted. So there's quite a lot of extra money available to target some of these projects in the second half of the year.
Services is another really big push in China. The idea is to make this a services-rich economy. Just talk us through the thinking behind that and how that might help grow.
Improving services, China's economy does need to rebalance from the intense investment-led manufacturing sector. There will obviously be a lot more invested going forward in the high-end, high-quality end, and the technologically based things, and indeed in pharmaceuticals. But the silver economy, or i.e. the care for the elderly, and providing an economy which encourages the older members of the population to actually spend more. More efficient and better provision of that. Particularly, there's a target of trying to improve demand in the rural areas of China, above and beyond the urban areas. That will basically be an improvement, particularly if it can be done without high costs. And that's where the application of AI and advanced technologies such as robotics will definitely help.
Yeah, it's a very interesting time. I want to speak to you about China in the world because, of course, the Politburo also spoke about the importance of trade relations, the need to normalize trade relations. But all of this, of course, Mark, against quite a volatile global context. We don't know where tariffs are going. Well, they seem to be worsening at this stage. But also, we don't know the impact the Middle East is going to have on any of us.
Yeah, I mean, the impact of the Middle East on raw materials prices and energy prices is a big unknown. China has a long, good and strong historical record of managing that very, very well, but there's only so far one can go with good management processes when there's so much uncertainty. But on trade, I would say that Chinese external demand is proving to be very robust. And it's proving to be very robust because as much as trade with the US has diminished, trade with other parts of the world continues to increase, not only with Europe, because Europe basically is no longer competitive in a lot of industries and it's easier to actually import from China, but also with regions such as Africa, still strong growth in exports to the Middle East and indeed to South America. And that's really where the real growth area in trade for China is going to be. It's proven to be a very strong trend, particularly over the past year.
All right, thank you so much. Mark Oswald is Chief Economist, Global Strategist at ADM Investor Services International. Chinese Vice Premier He Lifeng has expressed concern about recent restrictive measures by the United States. He held a video call with US Treasury Secretary Scott Bessent and Trade Representative Jameson Greer. Now, they agreed to step up communication. It comes just after the United States announced a ban on foreign-made humanoid robots, many of which, of course, are made in China. Beijing has vowed to retaliate. China's energy sector has now reached a milestone in other news. Coal is producing less than half of the country's electricity for the first time. In the first 6 months through June, coal-fired power plants contributed 49.7% of electricity output. Renewables now account for more than 40% of China's needs, an all-time high. Now, US economic growth slowed in the second quarter, weighed down by a wider trade gap. But stronger consumer spending and heavy investment in AI technology suggest underlying momentum remains. Our correspondent Mitch McCann joins us now from New York. Hello, Mitch. So the fresh data comes just a day after the Fed decided to hold on any movement around the interest rate. But what does this data tell us about the US economy?
Yeah, hi Sally, nice to join you from New York. Well, what it tells us is that the economy here is showing signs of slowing rather than stalling. These latest GDP numbers show that the economy is still growing despite the headline figure just being 1.5%, missing the expected target from analysts of 1.8%. So a little off that expectation there. This will concern some, but I think it's important to look at, past the headline figure here, because the decline in spending from the federal government and inventories dragged that figure down. But at the same time, as you mentioned, our personal spending was up 2.1%, and a key indicator of underlying demand, that's called the final sales to private domestic purchases, that was up 3.9%. So some good news within those numbers. Regarding the personal consumption expenditures, that is the PCE we talk about, that measure of inflation fell 0.1% for the month, mainly due to gas prices being down while the war in the Middle East was paused, but the annual rate of inflation was 3.7%. So that's in line with forecast, but well above that 2% target that the Fed has missed for a number of years now. Now, this is more data that the Fed will take into account at its next meeting. Yesterday, it decided to leave rates unchanged while it reviews more data like this, but three of the governors at that meeting had pushed for a rate hike, so it's going to be interesting at the next meeting to see how much that pressure builds on Kevin Warsh and his colleagues to enforce a rate hike later in the year.
And Mitch, how have the markets been reacting to the big tech earning results that came out after the closing bell on Wednesday?
Yeah, look, on Wednesday, two of the Mag 7 companies reported their earnings, and investor reaction was vastly different for each of them. Now, Microsoft was one. It posted higher than expected revenue and 43% growth at in its key Microsoft Azure cloud business. So its stock today, a short time ago, was up 14.38%. So an excellent result for Microsoft. On the other end of the scale, Meta, Facebook's parent company, its forecast revenue was lower than what analysts were expecting, and its free cash flow was way down as it puts more money into AI investments. Obviously, we've talked about the fact that investors are worried about how much money these companies are putting into AI. A short time ago, Meta was down 8.85%, so big losses on Thursday. If we look at the broad markets very briefly that we follow, our broad indexes rather, the Dow Jones Industrial Average was up 0.69% a short moment ago, S&P 500 up 1.23%, and the Nasdaq is certainly back up 2.47% after a very difficult few days for that index. So positive signs on Wall Street for investors today, but still about 4 hours left of trading.
Thank you so much, Mitch McCann, our correspondent in New York. Here in the United Kingdom, the Bank of England has also kept interest rates unchanged at 3.75%. Policymakers have warned the extended conflict in the Middle East and higher energy prices could force rates higher to contain inflation. The decision came after a split vote, with officials divided over the path for future rate cuts. Europe's governing football body has voted to boycott the World Cup if Gianni Infantino's proposal to sell stakes in the tournament to private investors goes ahead. In a statement, UEFA and its 55 members declared the World Cup was not for sale and should not be treated as an investment product. Samsung Electronics has reported record quarterly profits of $62 billion, helped by booming demand for memory chips used in AI systems. But despite the strong results, shares slipped 0.7% as investors focused on concerns over future growth, including competition and whether the AI-driven chip boom can continue at the same pace. Shell's second quarter profits have more than doubled as the Middle East conflict pumped up oil prices. In the 3 months to June, the company reported almost $10 billion in earnings, marking its second highest quarterly earnings on record. Europe's largest oil and gas company has seen profits surge by 70% for the first half of this year. This is Global Business Europe. Still ahead. Carmaker BMW moves into the slow lane with falling sales in China and second quarter results hit by the Middle East conflict.
Everything is a business story.
Welcome back to Global Business Europe with Sani Baudet. Your headlines. China bets on artificial intelligence and advanced manufacturing as the world's second biggest economy sets out its growth plan. The economy in America loses momentum as it weathers the financial impact of tariffs and the conflict in Iran. The Eurozone economy grew faster than expected last quarter, expanding 0.4% as AI investment and government spending helped offset high energy costs and the impact of the war in Iran. The Eurozone covers the 21 countries that use the euro as their official currency. Europe's biggest economy, Germany, grew by 0.2% in the 3 months from April to June. Now, that is a slowdown from the previous quarter, but it's still higher than expected. Italy's economy grew by the same amount. It's holding up better than many forecasters feared in the face of the surge in energy costs linked to the war in Iran. Higher growth recorded in Spain, which expanded by 0.7%. It's been one of the top economic performers in Europe, in part thanks to record tourist numbers. And let's digest all of those numbers with our correspondent, Will Denzelo, who joins us from Brussels. Hello, Will. So, what does all of this data tell us about the health of Europe's economy and which countries are doing well, which ones are still struggling?
Well, as you rightly mentioned, this is somewhat of a shock. Many analysts were expecting rather muted performances when it came to the second quarter GDP, considering some of those headwinds that you mentioned, the likes of those rising energy prices, the impact that the conflict in the Middle East and the closure, really the large-scale blockade of the Strait of Hormuz has had not just on the European economy, but the global economy at large as well. Let's, of course, not forget that these constant threats that we've been seeing over recent months from the Trump administration when it comes to tariffs. Now, while the Turnberry Agreement, the EU-US trade agreement, has come into force, of course, you can't forget the disruptions, the uncertainty that the last few months has had for businesses that rely on that transatlantic trade. Now, when it comes to the figures, well, GDP, according to this initial estimate, up at 0.4% quarter on quarter, twice as good as expected. And looking at the winners or losers, well, one key bit of narrative coming out of this data is that the difference in growth between member states is stark. If you look at Ireland, for example, the best performing member states, they saw growth at 3.9%. Also some strong performers. You mentioned the likes of Spain and Portugal. Again, strong growth there. Lithuania up at 1.7%, Sweden 1.4%. Take in contrast, though, Belgium, here in Belgium, that was flat, as was Austria. Germany as well, Europe's largest economy, better than expected, but still slightly anemic growth at around 0.2%. And considering the fact that inflation remains linger, there might be some optimism out of these data, but still some underlying concerns, something the EU is desperately seeking to address as it aims to be more competitive going forward on the world stage.
Tell us more about these plans announced today by the EU that they're going to build 7 massive AI data centres.
That's absolutely right. The call for tenders is out over the next couple of months. There'll be bids coming in to the European Commission as part of an enormous strategy as the EU aims to be, in the words of Ursula von der Leyen, the European Commission President, to be the AI continent. So big ambitions from the EU, and they're seeking to put their money where their mouth is with these huge investments as it seeks to better compete with the likes of the US and China.
All right, thank you so much, Will Denzelo in Brussels. The International Energy Agency says the energy crisis sparked by the war in the Middle East has brought fuel price volatility back into sharp focus. And that contributed to surging sales of electric vehicles in the second quarter of 2026. Here's our correspondent Siobhan McCall, who has more details. Hi.
Hi, Sally. Yes, electric car sales are proving resilient despite a weakening global car market. They rebounded in the second quarter, up 35% compared with the first 3 months of the year. Sales reached record levels in 50 countries, including Brazil, India and South Korea. EV sales are now expected to reach 29% of total car sales worldwide this year. That's 1 percentage point higher than had been projected in the global EV outlook. China leads the world in the sale and export of EVs. Chinese customers are also pivoting to domestic EVs, and this is hitting the European auto sector. German automaker BMW says a steep drop in sales in China and a hit to consumer confidence because of the Middle East crisis was behind an almost 35% plunge in second quarter net profit. Vehicle deliveries in China were down nearly a third. BMW is planning to axe 8,000 jobs by the end of next year. Stellantis' European operation remains in the red despite a global return to profit. Second quarter revenues were up 13%. The group, which owns Jeep and Fiat, says this was due to strong sales in North America. Stellantis and China's Leapmotor are starting joint car production in Europe later this year. Renault, however, recorded a more than 9% rise in first half revenue and swung back to profit thanks to strong electric vehicle sales. The French car maker says it has no need to cut its European capacity despite growing Chinese competition in the region. It does have a strategic partnership with Geely in Latin America. Well, let's get more on this. Daniel Harrison is an automotive analyst at Ultima Media. Daniel, thanks for joining me. Chinese automakers are capturing a bigger share of the European market faster than analysts expected. What do you think the reason is for this?
Yeah, good to speak with you. There's many reasons. Fundamentally, the cost base for producing vehicles for, legacy automakers in Europe is much, much higher than new startups in China. So much so that many of the European manufacturers have abandoned producing entry-level or A-class vehicles that are affordable to consumers. And China has seen an opportunity here. That there's a gap in the market, that those manufacturers are not catering to those consumers with a modest budget, and China's now starting to flood the market with affordable vehicles. So they've really stolen a march there.
While Chinese companies are doing well, the European ones are struggling. We're hearing about layoffs at the likes of BMW. What do you think the key reason for that? Is it competition from China, or is there other reasons too?
There's multiple reasons. So the first primarily is that up until over the past 20 years or so, China has been a huge export market for many European OEMs, particularly Volkswagen, BMW, Mercedes and Porsche, companies like that, and also to the US. So on China, because the competition from domestic Chinese manufacturers has matched or even improved upon the quality of European manufactured vehicles, they're drastically losing sales there. And in North America, because of the tariff implications, European manufacturers are struggling to export as much there. So they're being hit on both fronts there. But also, as I said, the much higher cost base makes it much more expensive to produce vehicles in Europe. In fact, that's why Volkswagen and many other players have set up joint ventures and plants in China to produce vehicles much more cheaply. And in some cases, including Tesla, are actually exporting them back to Europe.
I was going to ask you about these joint ventures like the one with Stellantis and Leapmotor. Do you think they are the future of the car sector in Europe?
Yes, very likely so. I think they're not the entire solution, but they're probably the least worst option. The alternative, unfortunately, would be that you'd have to close some pretty flagship plants across Germany, primarily, Volkswagen, BMW, Mercedes, but also Stellantis possibly and Renault. And that would be very painful in terms of job losses and the loss to GDP and the impact upon the economies more broadly. And, you know, European automotive is a pretty vital pillar industry across Europe, and we're pretty proud of it, particularly in Germany, is a great export market. And it's you know, that's why the European Union is very keen to hold on to that. Hence the tariffs that they've introduced to try and hold back that tide of Chinese imports.
Thank you, Daniel. Daniel Harrison, automotive analyst at Ultima Media. And back to you, Sally.
Thank you very much, Siobhan. All right, your headlines again. China bets on artificial intelligence and advanced manufacturing as the world's second biggest economy sets out its growth plan. The US economy loses momentum as it weathers the financial impact of tariffs and the conflict in Iran. And Eurozone growth hits its strongest pace in more than a year, reaching 0.4%. That's it for Global Business Europe. Thanks so much for watching. We've got more on all our stories at europe.cgtn.com. Do follow CGTN Europe on Facebook, Instagram and TikTok. And you can go to CGTN Europe's channel on the Telegram app, scan the QR code on the screen to get stories and updates sent direct to your phone. Up next on CGTN is Africa Live. We'll see you again tomorrow. Same time, same place. From all of us here in London, goodbye.